Before you apply for a mortgage, stop. The score you see on Credit Karma or Experian may not be the one your lender actually uses, and that mistake could cost you tens of thousands of dollars over the life of the loan. So let me show you the real scores that matter and how to raise them fast. Have you ever checked your credit and thought, why does Experian say one thing, Equifax says another, and then TransUnion something completely different? And most importantly, which one actually matters when you're buying a home? I've been in the real estate and mortgage lending for over 23 years. I'm not just a realtor and a mortgage broker, but I've also been a direct endorsement underwriter for FHA and conventional loans. I can tell you loans are approved or denied every single day over just a handful of credit score points. So today I'm going to break down for you how the credit bureaus work, how FICO scores really function, which models mortgage lenders actually use, and the proven strategies including student loan deferment tips that can raise your score and save you thousands of dollars. And yes, I'll also back it up with sources so that you can further research this topic. All right, let's start with the 3 credit bureaus. First, Experian. Their global headquarters is in Dublin, Ireland, but their US headquarters is right here in Costa Mesa, California. They track over 1 billion consumers worldwide, and they're unique because they have Experian Boost, which lets you add utility and rent payments to your report. But remember, it only impacts your Experian score, not the other 2 credit bureaus. Next, TransUnion. They're based in Chicago. They cover about 1 billion consumers in more than 30 countries, and they're investing heavily in AI-driven analytics to help lenders determine credit risk and other credit considerations. And then we have Equifax, the oldest bureau, founded in 1898. They hold more than 800 million consumer files worldwide, and they're also the company behind the 2017 data breach that exposed information on roughly 145 million Americans. Now here's the catch. Not every lender reports to all 3 credit bureaus. You might see your car loan on TransUnion, but not Experian, or your credit card on Equifax, but not the other bureaus. That's why your credit scores often are different. In mortgages, we don't just pick one bureau. We pull a tri-merge report and take the middle score, not the highest and not the lowest, the middle score. I had a client, we'll call him David. He walked into my office feeling confident with a 710 score from Experian, a 681 score from TransUnion, but his Equifax score came back at 652. That meant that his middle credit score was 681, and that's the one that counted. The small difference cost him a higher rate. Lesson: you don't have one credit score, you have 3 of them. Before we dive into FICO and how it actually works, do me a favor, subscribe and turn on notifications. I don't just make fluffy videos, I make videos that are actually useful. If you're serious about buying, selling, or just managing your money better, you don't want to miss the next one. Now let's talk about FICO. The Fair Isaac Corporation. Over 90% of top US lenders use FICO scores. Scores range from 300 to 850. Here's how the formula breaks down. Payment history, 35%. Do you pay on time? Late payments weigh the heaviest. Amounts owed, 30%. That's your balances compared to your credit limits. Length of history, 15%. The longer you have managed accounts, the better. Credit mix, 10%. Lenders want to see a variety of credit cards, car loans, maybe a mortgage. New credit, 10%. Too many new accounts or hard inquiries can hurt you for many things, not just one thing, like a mortgage. If you're getting hard inquiries for mortgage loans, car loans, credit cards, and other things, you can bet your credit score will take a hit. Now here's where people get confused. Different FICO versions exist. For mortgages, we use the classic models, FICO 2 for Experian, FICO 4 for TransUnion, and FICO 5 for Equifax. These are the ones mandated by Fannie Mae and Freddie Mac. Consumer FICO scores like FICO 8 and 9 are the ones you'll see most for credit monitoring apps. They treat medical debt differently and sometimes factor in rental payments, but mortgage lenders don't use them. Then there's industry-specific scores, like the FICO Auto Score or Bank Card Score. Those can range from 250 to 900, but again, they're not used for mortgages. Here's a story. Maria walked into my office proudly showing her Credit Karma app. She had a 690 score. She thought she was good to go. But Credit Karma uses VantageScore, not FICO. When I pulled the actual mortgage FICO score, her middle score was 641. That gap 49 points. It raised her monthly mortgage payment about $170 on a $500,000 loan over 30 years. That's more than $60,000 extra. Same person, different scoring model, huge impact. Now the part everyone wants to know. How do you raise your score before buying a home? Well, here it is. Here are 10 strategies. Pull all 3 reports for free at annualcreditreport.com. Number 2, pay on time, always. One 30-day late can drop your score 90 to 110 points depending on your personal credit mix. 3, lower your credit card balances under 30%, ideally under 10 of whatever your credit limits are. 4, ask for credit line increases, but don't spend more. 5, avoid new accounts right before a mortgage. 6, don't close old accounts. They help your credit history length. 7, diversify your credit mix. 8, try Experian Boost. It adds utilities and rent to your Experian score. 9, become an authorized user on someone else's well-managed account. 10, and if your credit is messy, work with a HUD-approved credit counselor. One of my clients had a 612 score, but paying down just $3,000 in balances, he dropped his utilization to 9%. Within 45 days, his score jumped 66 points to 678. That moved him into a better pricing tier and saved him thousands. By the way, there is a method of boosting your credit score in as little as 3 to 5 business days. Reach out to me for more information about that at therealtorbroker.com. Now let's talk about student loans, because they do play a huge role in credit scores. When managed responsibly, they can actually help. On-time payments build the biggest part of your FICO payment history. They're installment loans, which improve your credit mix, and many people open them when they're young, which lengthens your credit history, and that is good. But here's where it gets a little risky. Missed payments on student loans can tank your score. A single delinquency can drop you anywhere from 50 to 170 points. Federal loans report as delinquent after 90 days, and if you hit 270 days, they go into default. That default can stay on your report for up to 7 years. And since the pandemic payment pause ended, student loan delinquencies have surged, jumping to almost 8% nationwide, dragging down the average scores. Now, here's the myth buster. Deferment does not hurt your FICO score. When loans are in deferment, lenders report them as deferred because no payment is due. You're not penalized. In fact, deferment can actually protect your credit score because you're not missing payments. Yes, interest may still accrue, which means balances can grow, but that doesn't immediately hurt your credit score. The danger comes if you miss payments before the deferment begins or after the deferment ends. And here's the bonus. Those deferred bills still count towards the length of your credit history, which is a positive. On a side note, deferred student loans are included in your debt-to-income ratio for mortgage qualification. For Fannie Mae conventional loans, if there is no payment listed on the credit report, lenders must use either 1% of the outstanding loan balance or a documented, fully amortizing payment. Freddie Mac, FHA, and USDA loans require lenders to use either the actual payment listed, or if the reported payment is 0, or the lender is deferred 0.5% of the outstanding balance as the monthly payment when calculating DTI. VA loans generally exclude deferred student loans from DTI if the loan will remain deferred for at least 12 months after closing. Otherwise, the lender uses the actual payment or calculates a payment based on 0.5% of the balance divided by 12 months. These guidelines affect how much you can qualify for when purchasing a home. So it is important to know which standard applies to your situation. I once had a client named Jasmine who was terrified that the deferment would actually ruin her credit. But because her loans were in deferment, not delinquent, her score stayed solid. The only risk was when deferment ended, so we set her up on autopay so she wouldn't miss a beat, and she kept her credit score in the safe zone for her mortgage. Now, if you know someone who's thinking about buying a home soon, maybe a friend, coworker, or a family member, do them a huge favor, share this video with them. The wrong assumptions about credit can cost buyers tens of thousands of dollars in higher interest. Don't let that happen to the people you care about. So what do lenders actually require? Conventional loans, 620 credit score minimum, but 740 plus gets you the best pricing. FHA loans, 580 with 3.5% down, 500 with 10% down. Most lenders set their floor at 580. VA loans, The VA doesn't set a minimum, but most lenders want at least a 620. USDA loans, typically 640, depending on the lender. If you can push your score up into the mid 700s, ideally 740 or higher, you'll unlock the best interest rates available. So here's the bottom line. Experian, Equifax, and TransUnion, 3 different versions of your financial story. FICO, the scoring system lenders actually trust. Strategies like lowering utilization, paying on time, and managing student loans wisely can move your score quickly. And deferment, when handled properly, doesn't hurt your credit at all. Again, if you know someone struggling with their credit who wants to improve their score, share this video with them. It might actually be the roadmap that they've been searching for. And for you, if you found this valuable, subscribe, hit the notification bell, and drop your questions in the comments section below. I'll answer every single one. Because in real estate and in mortgages, knowledge isn't just power, it's money in your pocket, and we could all use more money, right? I'm John Abril, the Realtor Broker. Thank you for watching.